I ignore 80% of the reversal patterns that I see in the market. Patterns like head and shoulders patterns make absolutely no sense unless you trade a reversal pattern in line with higher time frame context. If you do, you can hit 2.5 hour trades like this time and time again. So let's just run through a quick example of a reversal pattern playing out on USDJPY. We'll then look at two of the best reversal patterns that you can trade, and then further examples on gold. And I'm going to keep this to 10 minutes. So let's just take that away, and I'm going to show you step by step how to get involved in this trade. So as I said, irrespective of the patterns that you're seeing in price action, they don't mean anything unless you look at higher time frame context. So I'm going to look at the 12-hour time frame and combine that with weekly, 2-weekly, and monthly trade ideas. So first and foremost, if I overlay a weekly candle onto my time frame, I can basically see what's happening. And as we pick up price right here, we have an uptrend. So price is expecting these lows, this internal range liquidity, and it's buying, there's demand into the external range liquidity at the high of this weekly candle. We then get a continuation and I think a close above the high, and then we get a sell-off. What this basically gives you is a shift, a true shift in market structure. And this can be seen that once price closes below this swing point, which happens to be the nearly coinciding with the previous week's low. Once we see the weekly candle close, what we identify is that we have raided the liquidity above this high. So price has pushed in, broken out above the weekly candle here, raided this external range liquidity, and then we've seen a true shift in market structure. And in doing so, what we've done is created a bearish price leg. So at the top here, we have our extreme order block, the last buy to sell. We also have fair value gaps right here, bearish fair value gaps. And I'll mark them in red for clarity. So this is the imbalance between the candle 1 and candle 3 in this downtrend. So these points of internal range liquidity are areas that we can take reversal trades because we have higher time frame context. And that context is that price overall is bearish. We've raided key liquidity above a previous candle's external range. And now we have a natural draw on liquidity lower, which is essentially target 1, the low of this candle, and target 2, a continuation of the downtrend overall. So with that said, we can simply set a short position at the entry of the fair value gap and then just cover either the liquidation of these highs or the swing point itself. And we can just wait then for price to sting in to this internal range liquidity and then draw towards the low. So target 1, you're looking at a 1.12R. Target 2, a 2.25R. And if you want to hold to something like a 2.5R to get that continuation, that's perfectly fine. And that plays out really well. So the reversal steps right here are waiting for a raid of external range liquidity, a close, a second close right here in this candle, whereby we see a confirmed liquidation of this high. And then we're just looking for shorts to ride the continuation of this reversal trend. So that's how this plays out. But let's look at a bit of theory. So reversal patterns are price action formations. They are patterns, but they signal potential trend changes only when we've raided or we've purged external range liquidity at key higher time frame levels. So what market makers will do is print these patterns all over the place, but they only work when they're in context of the higher time frame story. And that's what I spend all of my day creating content around. Most traders spot reversal patterns like double tops, head and shoulders, engulfing candles, and they just immediately enter with no additional context. And this means some trades win, some lose, you have no context, and you can't get better as a trader. So before we move on, let's look at two options for trading reversals. One option in the example that we just saw is where price is moving in a certain direction. We see a structural shift, and then we can trade a continuation move. And what we're doing in this area here is we are breaking above candle ranges on higher time frames and purging external range liquidity so that this shift in structure, just like we saw right here, actually makes sense. The second option that we have is to get involved before we see a structure shift. So we see highs being taken, we come into external range liquidity, and then essentially we get this type of thing happening. And we want to be able to get involved in the reversal before we actually see a close below this low, because that way we're going to get even better R multiples on our trades. So if we look at a second example on gold right here, what we see is the exact same thing playing out. We basically get price breaking above a high and closing inside its previous candle's weekly range. So we can mark that as a liquidation of the high. And then what you see is that price came into this area aggressively, so respecting the liquidity right here, this order block, breaks up, and then basically what we get is an order flow shift. So what we see is that we haven't actually broken below this low. This swing point is still intact. So what you could think is that price is going to find some liquidity and go higher. But we have this sweep, and we also have higher time frame targets lower in this range. So instead of waiting for a structural shift, we can get involved in the creation of internal range liquidity in this sell-off. Now let's just mark this up. We have, again, an order block right here, a 12-hour order block, and the exact same thing happens. We get the formation of a bearish fair value gap right here. So candle 1, candle 2, imbalance. What happens? We get price trading into the imbalance. Even though there's been no structural shift, we then get further confirmation and the formation of an order block. So if we pick up price right here, we have a second 12-hour order block. So you have two options. One, you can actually get involved before we see any shift in structure. Either you cover the swing point or the liquidation of the high. I prefer to take the swing point, and then you can target the opposing end of the range. So that would be a 1.5R. But you can see we have other targets down here that make sense on higher time frames. This eventually plays out for nearly a 4R trade. Option 2 is you just hold off and you wait for further confirmation. Price stings in and creates new internal range liquidity with a new swing point, a new order block to trade from. Cover the high, and again, we can either aim for the low, 1.84, or we can take the additional targets that we talked about. And now you're getting up to sort of 6 or 7 R multiples. So this is how you use two different things. One, structure shifts, and two, order flow shifts. Once you can start to time these around the right context on the higher time frames, you can absolutely kill it as a trader. Now, how do you apply this consistently? Establish your higher time frame bias. Wait for raids or liquidations of external range liquidity at key higher time frame levels. Ensure pattern reversals, because that's all they are. They're patterns, have formed in context. You need this higher time frame. Then trade using high probability entry criteria. So enter at the right place, stops at the right place. And I have dedicated videos on those things. My model is that I track and analyze 32 Forex pairs, including gold, silver, and Bitcoin. And I just track the 12-hour price action in conjunction with monthly, 2 weekly, and weekly closes. I just wait and execute. And when you get good at this, you can do it in 10, 15 minutes a day, and then just go and live your life. So I create a lot of content on this, and I cover every aspect of swing trading. So if you like this type of content, please subscribe.